So there's a number of wildcards that could impact the Fed's rate path. Among them are consumer spending. Over the last several months, we have seen consumer spending growing faster than consumer income. It's a condition that could probably not last forever. As people's savings rates have diminished, eventually they may have to cut back on consumer spending. And if they do, that could push the Fed to cut interest rates more than the market currently prices. On the other hand, once a new administration takes power, if they cut taxes or raise spending, that could provide the economy with a fiscal boost and make rate cuts less necessary.
Because if you're thinking about the point of accommodation for interest rates, you have to think of it from the market perspective and the real economy perspective. One thing we're watching very closely and asking the question is if the pain within some portions of the consumer, the lower income consumers, could the pain that they're seeing, as we're seeing within default rates and challenges for credit cards and auto loans, could that pain be enough to pull the rest of the economy lower?
So U.S. consumer debt is already becoming somewhat of an economic issue. In recent quarters, we have been seeing a sharp rise in delinquencies on both credit card loans and auto loans that respectively have risen to their highest levels since 2010 and 2011. But this is in the context of a strong job market. So imagine if unemployment begins rising and we start seeing job losses, that could cause more consumers to fall behind on their debt service payments and increase those delinquency rates further.
We think a big wild card for 2025 will be the bond market's digestion of fiscal stimulus. So the challenge for the bond market will be potentially having to digest these much higher deficits going forward. And what does that mean for yields? A good reminder is in the third quarter of 2023, we saw a big move higher in the 10-year Treasury yield, and equity markets didn't like it. So we still think that bond markets do very much matter for this equity market. We think earnings are the biggest driver overall, but bond markets could be a source of volatility as we go into 25.
So in 2025, bond markets could be at a fork in the road. Either we have a soft landing or continued growth, in which case yields could drift higher and expectations for Fed rate cuts could diminish, or we could have an economic downturn in which the Federal Reserve could wind up cutting short-term rates far more than the market currently prices. Now, what that would mean for long-term interest rates is difficult to say. Back in 2008, when the Federal Reserve put interest rates at zero for the first time, 10-year and 30-year yields really didn't come down all that much, in part because budget deficits were very large and there was a lot of debt issuance.